So, Paul, it's great to have you on the show. Maybe before we jump into the conversation, it would be a good idea for listeners to know who you are and what Cedar Grove Capital Management is.
Yeah, absolutely. Thank you for having me. So background context, my name is Paul Cerro. Started off my career in investment banking, actually, at Bank of America Merrill Lynch here in New York City. Over the past over 6 years now, I've been on Wall Street. I've also gone into the tech industry where I've been able to help grow companies from a strategic sense, so like a strategy perspective. And I started Cedar Grove Capital a couple of years ago, just writing just like everybody else. But in the most recent strategy that I've been implementing, Cedar Grove Capital has been doing a multi-strategy um, type esque strategy where we do hold long positions, we do hold opportunistic short positions, and then we also do special situations. And that's just in order for us to kind of like balance out the portfolio risk and hedge our core long positions over time. So I mean, I'm always happy to jump into that, but that's like the quick 30-second spiel about my background and what the fund is.
No, that's great. This episode, as a little spoiler, it's going to be about not the long side, but the short side. But before going into shorting, maybe let's jump into the specifics of your long investments. How would you characterize yourself as a long investor, and what traits do you look for in a company when you're going long?
Yeah, so we lean long as far as portfolio construction. So it's not like, oh, it's evenly split or anything like that. It's primarily holding long positions. That's going to be anywhere from 60 to 70% is going to be core long positions. When I keep saying core, it's because we've done the work to where um, without anything changing, uh, we expect to hold these companies for a multi-year period. And the reason why that is because um, and I should have emphasized this earlier. So we operate in the small cap and micro cap space. We don't go above that. I mean, we do have one exception right now, but that's just where we live. So you can imagine there's going to be quite a lot of volatility in those micro cap names and those small cap names because they're so small. They might not have the recognition from sell side analysts or just broader exposure to the industry, right? So in order for our thesis to materialize, it's just going to take a few years, at a minimum, right? So our core positions will take that much time. We look for ones that are already profitable, but that doesn't mean they always have to be profitable because if you can imagine if you're a small company, there probably is going to be some inflection point that's if they haven't already. Um, but my main focus whenever I invest in these core longs is I just need to be able to understand this business. If it's too complicated and it could be like a home run, I just really don't feel comfortable investing in it. I gotta make sure that it is simplistic for me to understand, and there's a lot of areas within that that I just won't touch because I don't understand it. I'm not gonna pretend like I understand it, and I'm not gonna start gambling because I think I know something. Um, so there's going to be a lot of back and forth internally about what would be considered a core long, but it's mainly for small companies that have great growth potential, basically strong tailwinds, either already are profitable or inflecting towards profitability. Their dilution is not aggressive because you can imagine if you're scaling up a small company, there could be heavy dilution, so we don't want that. Some decent management buy-in, so there's an alignment of long-term goals and long-term strategy and long-term payout. And then, like I mentioned before, it's got to be in a space I either currently understand or can easily get ramped up to. Anything after that, uh, it's not for me. But those are like kind of like the core things I look for when I'm looking at the long side of things.
And one thing I think is interesting, or at least that I find interesting, is that when you are in the, let's say, mid to large cap space, finding ideas is probably easier, like building up the funnel of ideas. But when you're in the small and micro, especially as you said, looking for companies where numbers might look misleading, right? Because you're waiting for an inflection. Finding ideas might be actually a challenge. So how do you build your funnel of ideas until to basically have ideas to research, which later might make it into your portfolio?
Yeah, so that's a good question. Because it comes, I mean, idea generation, we can probably chat about it too if you have time on your side, but you just have to keep turning over rocks. It's especially when there's not enough coverage of things, you just have to keep turning them over. So when it comes to idea generation for sourcing, there's you can look at your articles being written on Seeking Alpha if there's literally anything there. Twitter, there's going to be usually there's somebody that has spoken about it, whether it's high quality or not. Somebody has probably spoken about it. Then you have like, all these other services that compile all the external newsletters into one, right? I'm gonna plug them in here, but like like I'll use like Yellow Brick for instance because he just scrapes everything on the internet and you can filter it out to whatever you want. And then if there's nothing that like I've seen at the moment that has come from somebody else or through the grapevine, then I'll see if I can get an idea from maybe something I've read, right? So if I'm reading the Wall Street Journal and there's like a topic that's interesting, I'll start researching into that topic. Okay, who are the players? Oh, okay, how big are they or how small are they? Okay, and keep going down there. Same thing if I'm reading like Bloomberg, Barron, it doesn't even matter, just online publications, just reading because I'm interested in it, and then diving into something because I want to know who could potentially come out of that spot, a bigger player, right? And then when all that else fails, there's the good old stock screener, right? And you
Mhm.
just like do some basic filters. You don't want to go, I mean, in my opinion, I don't want to go too heavy in filters because then I might miss something that I otherwise might not have discovered, right? And I'm looking at my pad right here. There's probably about 50 names on this piece of paper that I have to go through. And then yeah, you just go one by one and you just like basically spend a certain amount of time for like a high level. Is this interesting enough? Like, do I care to go deeper right now, or can I kind of like put that on the side right now? So yeah, it's a large portion of my time is just spent trying to find things. Um, and then once I've kind of narrowed down that list, like down the funnel, then I'm like, okay, cool. Let's go into it. See what the story is. I just posted one today, which was a really interesting story. Um, and see if there's any money to be made here.
And do you lean into? Do you consider yourself a generalist or a specialist? And
Yeah.
if you lean into certain industries, what do you think makes those attractive?
So now I say I am a generalist, but there are industries again that I won't. I would keep them last if I had a gun to my head to invest in. And that's not because there's not potential there. It just goes back into what I said earlier. If I don't understand, like I'm never. Well, I mean, don't say never. I will most likely not understand the dynamics of the oil and gas industry
Hmm.
very well. That's just not me. It's outside my competency. I will also, and this one I can probably say never. I will never understand biotech, the drug pipelines and like what they cure, et cetera. Looking at medical papers about you know clinical trials. I'm never gonna understand that.
Hmm.
You can always talk to people, but I'm never gonna understand that. So my initial start was in consumer goods and retail, and that's because it's just a very, very easy space to understand, right? It's everywhere where you and I can either physically go into a store and buy something, or we can go online and make a purchase. It is
I've
not
always
rocket
thought
science.
I've always thought that the retail industry is maybe too easy to understand because it may lead to overconfidence, and then if it works, if a business model works well, it's very, very profitable. But the difference between working very well or going bankrupt is actually in execution most of the time. So it's obviously there are exceptions, but when
Yeah.
you're leaning into fashion, then I always found that pretty tough, and I've made mistakes in that industry, and now I'm a bit skeptical of it.
Well, you and I have talked about that in the past. It's like, because I know you and I had overlap in luxury back when I was actually doing like large cap names, right? So we would talk luxury. Like, yeah, and you mentioned a good point, fashion. Clothing is hard. Clothing is a hard business to invest in, right? Because you can have, if you caught Lululemon early on, you did very, very well because you probably noticed them revolutionizing athleisure, right? But and same thing with like Nike. Nike went from shoes to then other sports to then clothing to then wholesale to then a bunch of licensing, whatever. But then there's other places that didn't do too good. Like look at Burberry right now. Burberry was once the pinnacle of English fashion, like English high fashion, and they've gone down the tubes, right? Then you have the American side, right? If we're going, I might call them luxury, but if you're going to the American side, Capri Holdings, Michael Kors, completely went downhill, right? Versace, Italy, I can
I
arguably
remember
say they're not
reading
doing that well.
I remember reading a headline about Michael Kors that said that Michael Kors was was aiming to dethrone Hermes, and it was going to be the next affordable luxury. And I was like, affordable luxury probably are not a good combination of words if you want to dethrone Hermes.
Yeah, I mean that's just all like the headline, bait, right? But yeah, but like you said, clothing is more of a trap than a lot of things because like, you see the brand name like as you're walking down the street and oh wow, everybody's wearing Michael Kors. Michael Kors should be a good thing. But then you realize like, oh no, they're oversaturated. That's kind of why you're seeing so much Michael Kors merchandise and then the company sells off. So yes, consumer goods and retail is a very easy industry to understand, but it can also apply to overconfidence in your decision making because of just your ancillary data points from everyday life.
Mhm.
But then on the flip side, there's beverages, right? There's the consumer goods like packaged goods, food, etc. Like things that you might not basically see every day, but you could easily interpret, apply to that. I've also dabbled more into the technology side of things because, as you can imagine, consumer has been leaning into tech. So it's not even consumer or tech; it's consumer tech. So
Mhm.
now there's like that hybrid between the two. So that makes it interesting. So I'm not just trying to find the next SaaS company that can, be the next $10 billion, $100 billion company, right? Because it's coming from a consumer focused side. And then also recently is I've been trying to get more into healthcare. I think there's decent opportunity for money to be made in healthcare, and I know, and actually I haven't read it yet, and that's my fault. But you've actually put out an article, um, maybe not last month, but maybe in December about how like AI was going to
Mhm.
revolutionize healthcare or something like that.
Yeah, so
Um,
at the end, the goal of that article was to explain that healthcare is basically an industry where AI can increase productivity massively, but at the same time, you are to a great extent protected. Like the companies are to a great extent protected by regulation.
yeah.
Not like their mode is not in their product that AI can disrupt, but rather on the regulation that has already been written and probably is not going to change for a long time.
Uh, I agree, which is now I should probably read that this afternoon. But yes, I agree. So no, there's healthcare can be disrupted in dozens and dozens of ways. I mean, like again, I just wrote up an article today about a medical devices company that is I think can definitely have some upside. So healthcare is one, and that's something I understand too
And
because I came from a healthcare background.
another thing I find interesting about healthcare is that it has historically been a secular industry, but COVID basically changed that to an extent due to stocking and destocking. And I think um, it's been tough to wrap one's head around the numbers because they are not like they used to be. Hey, these companies grow steadily. Now you have a lot of moving parts. So the numbers are all over the place. Probably analysts that have been healthcare analysts for a long time are also a bit, let's say, lost in the cyclicality. So I think that also makes it interesting. But I mean, healthcare in general has gone nowhere since peaking in the pandemic, which is also normal, right? Because nobody knew how long the pandemic would be among us.
Yeah, I mean Moderna. I mean, not that I invested in it, but Moderna was a classic example of that. The stock went up to the moon for the vaccines, and then once the pandemic ended, the floor got taken out from under it, and now it's completely capitulated. No, it's a good yeah, it's a perfect example, right? Like there it was a non-sexy industry for a lot of reasons, but COVID just brought everything at the forefront, whether it was technology, holes in supply chains, holes in the ability to actually execute and perform either emergency or just regular services for patients. It was insane. It was just so much happening in such a short amount of time. To be able to digest all of that, just it was. If you were a geek about it like I was, it was a very interesting time to kind of see like everything being thrown at you at once because nobody knew it was happening, but everybody wanted to figure it out.
No, 100%. So I think that when you analyze a company, we're going to jump topics here. You basically have, as an investor, three choices. One is to buy the stock. The other one is to do nothing, which is, let's say, the most usual one is to do nothing, even if it hurts after all the research. And the third one is going short, right? So this podcast has historically been focused on the first of these, on buying a stock and going long. But today we're going to talk about going short, right? Which I think is also something that people should understand. So listeners will probably know that I'm not super keen on shorting. I mean, I have never shorted, and I'm not going to say that I will never short, but I think it's not in my plans right now. The reason is that I believe that let's say that one of the best characteristics of long term, long only equity investing is that you get unlimited upside technically with limited downside, and also that time is by your side, right? If you invest in a good company over the long term, as time goes by, then that probably plays into your favor. And I feel that the equation gets completely flipped around when you're shorting, right? You have technically unlimited downside with limited upside, and also time can be your enemy because you not only have to be right on the thesis, but exactly right on the thesis at the right time. So that said, I know I'm not a hater on shorting. I know that there are very different reasons why people short other than capital gains. So maybe it would be a good idea if you share what some of those reasons are, because I believe you apply a lot of them.
Yeah, no, so that was, yeah, I love how I had to put the disclaimer, hey, I don't like it, but I'm not gonna not do it. But no, so okay, so like, I mean, yeah, shorting gets a bad rap because yeah, depending on who you ask, will say like, oh, they're just trying to manipulate the stock. Oh, they're just trying to play into their own position, or whatever under the sun, right? But shorting is I mean, it's gotten harder over the years just because of market dynamics. But shorting plays a very important role in portfolio construction, depending on which strategy hedge funds are running, right? I mean, there's a reason why there are market neutral hedge funds who has a portion of you know, um, their short book in like equities, right, or just other non-correlated assets. So the reason why it exists, which I know because I know you've researched this, it's to be able to protect yourself if things don't go up all the time. That's basically what it is in a nutshell, right? And that's it. And that's if you're running both strategies, not necessarily if you're just like a short only fund, which obviously I'm not. But so shorting for me, um, it's so I'll back up. Investing in general, in my opinion, this always stuck with me. And maybe if he listens to your podcast, he'll hear me say this because I keep it. I tell everybody this. I think investing is, and this is coming from him, which I agree with, is basically a professional sport. You're not playing basketball. You're not dribbling a ball. You're not playing. You're not playing. I don't know how many of your followers are Europeans or Americans, but American football or soccer, etc. You're not. I'm not good at sports, but every single one of us is trying to outperform first themselves, then the market, and then probably your peers, because you want to be the best. You want to be able to
Mhm.
say, I generated X amount of returns. You know, I'm this good. It's basically what it is. Shorting is very, very difficult, as you alluded to, because you can have a right thesis. You can be dead on accurate, but if your timing is wrong, then it just destroys the entire thing. You can your unlimited downside can really bite you, which we can easily talk about in a bit if you want to touch on that subject. But
And I think GameStop probably proved what can happen if the market goes against you.
yeah, and everybody knows GameStop in its current form. Well, I don't know about currently because I don't track it anymore, but it's not going to survive. It's just not, and that's why you have like Ryan Cohen trying to invest in crypto and all these weird NFT things. It's just like Adam Aaron from AMC, playing into the retail crowd because, back then COVID theaters were dying, nobody was going to the theater, how do I get interest, etc. Everybody knows there's structural flaws in these businesses now that will eventually lead to like the next blockbuster, right? To end up closing or, any other named companies that eventually have just fizzled out and died because they couldn't adapt and they couldn't change and into the history books they go. So you can be right, but timing is very, very important. And for me, the reason why I invest in opportunistic. I say opportunistically because it's not like I just constantly hold short positions. I need to make sure that it makes sense. Otherwise, I'm just not going to do it. Um, so the reason why I do it is because number one, it helps protect me on any downside days where if we get a surprise that I did not foresee and the market just sells off, like, okay, cool. I'm not down as much. I'm still down, but I'm not down as much. But
Mhm.
the primary reason too is like it's a source of alpha for me, right? If I can find an opportunity where like let's just say I know something is most likely going to be happening in the next um, month or quarter or whatever, then that level of confidence helps drive a level of alpha to the overall portfolio because it's in theory um, disconnected from the rest of the market in theory. So that's why I do it. And the last thing is, yeah, it's really hard. So when you nail it, it feels really good. So there is a level of like, um, yeah, I got that. I got that right for the right
Mhm.
reasons. That's what it is for me.
And I think one of the reasons probably why shorting has gotten negative publicity lately is probably the business model that revolves around, let's say, the short shops and the funds, and how the funds were sponsoring some of these short research firms to that they were short before releasing a report. Then after releasing the report, the stock drops a lot, and then they profit massively from that, and they make millions and millions of dollars. While even they can be wrong, right? I mean, the thesis can make no sense, but you'll get the market overreacting maybe to the short report, because we must not forget that a lot of daily trading is algorithms, right?
Yeah,
So
yes, yeah.
that's mostly automatic. So what do you think about that? I mean, I understand why it receives negative publicity when I think that there's a fund sponsoring a short report just to make money of it.
No, I hate that too. Because it gives you a bad name. Not gives well, gives definitely gives them a bad name, but it gives the art of short selling a bad name. And so I'm not a fan of that. I'm more, if you're releasing short research, it's not so that you can flip it and make a quick buck. Because technically, in the eyes of the SEC, when you do that, that is just a timed dump, um, which is very frowned upon. And that's why Citron Research is currently in trouble with the SEC because it appeared that every time they released a short report, they sold quickly after, to recognize the drop in price. That's a no-no. You don't do that. If you're shorting something in a traditional sense, it's because you think that there is there's either just a flaw or a serious flaw in the business model that will lead to a significant share price decline. For you to do the whole release of report so I can recognize the 10, 15% whenever I choose to, whether I'm right or not, is no, that's not good. And I
Mhm.
definitely don't support that. What I'm that's not what I do or what anybody should be doing.
And how do you manage risk when you short? I mean, let's say, as you said, it's very difficult to get right. So when you get it right, you feel great, and probably that can lead you to get a little bit greedy, in waiting for the stock to drop more. So how do you manage risk in terms of position sizing and the timing of your position?
Yeah, I mean the position sizing is based on how confident I am of not just the outcome, so not just the thought of being right, but then also under what time frame. For instance, if I I'm just using rough numbers here. If I think something's going to happen within 6 months, that's a long time to be holding a significant amount of risk. So the odds are you probably wouldn't even do anything in the immediate term. You'd probably wait a bit. If I had to, for whatever reason, because I'm like, you know what, it can happen within the 6 months, but I really don't know when it could be happening in the next 6 months. Then you size it proportionately, which is like, okay, maybe a few hundred basis points in the immediate term. And then if I have to, or if the opportunity does present itself, I can push into that and maybe pump up a 3% position into like a 5% position. Um, and that's kind of how I look at things. But whenever I do short, it's mainly because either there's an impending catalyst that I can capitalize on uh, very quickly, or because there is a structural issue with the business where, absent any type of short squeeze meme stock mania, the company will eventually fall and die. And I have plenty of examples of that as well.
So let's talk about that. I mean, what characteristics do you look for when you short? And maybe as a another as a follow up, what what kind of scenarios have been your most profitable when shorting?
Yeah, you know what? My most profitable ones have been taking what management has told you and um, basically just calling BS on it. And I say that because there have been many instances, because as an investor, you know this too. We do our own research outside of public filings and investor presentations, maybe some webcasts that management has had. But for the most part, when you're understanding the business, you're listening to what management tells you because you're expecting them to know the business so well that whatever hints they can give you about the future is what you grab onto first. And then your supporting research either confirms that or maybe pokes a few holes or denies that. In my
Hmm.
view, my most successful shorts, and I've had a lot of them, is that management tells you one thing and it like really riles you up. Like, yeah, the future is great. It's so bright. Can't wait to be a part of it. And then when you do your own research, you're like, how are they planning to do this? This is actually mathematically impossible.
And then when
Um,
you go into Insider Screener, you see them dumping stock in the
dumping,
open
oh yeah,
market.
you see them dumping shares. Yeah, you're just like, huh, okay. They believe in the vision so much that they're dumping share. I mean, Palantir is a perfect example. Like the CEO believes in the future of Palantir so much that he keeps selling billions of dollars over the last, I don't know how many each quarter, every quarter. It's like ridiculous. Um,
Mhm.
that's not a good sign. But no, so it's my main home runs have been with management saying one thing, and then you doing your background research, your background math, and you're like, I don't think this could happen in the slightest. And once the market comes around to realizing that, um, the stock should fall. And there's plenty of examples there. And the one, and I will say the one thing that most short sellers, I don't say most, but the most public ones have done are the frauds, right? Like, your Enrons, your Nicolas. I know Hindenburg's, last farewell was on Carvana. It's basically them calling out fraud, which if the fraud is correct, then yeah, naturally the company is gonna, fall, die, capitulate, whatever. I haven't done that yet because I'm not a forensic accountant. I also don't have the patience to be a forensic accountant. But mine more stick towards what management says is overzealous, over optimistic, no way, shape, or form possible. And then also just that there's a structural decline in the business. Like the world is changing, and the business is not changing enough to change with the world, and it's going to be left behind. And so if you put your cards right, um, they'll basically be dead by death of a thousand cuts, unfortunately. But that's the way the world works. You can't be there to save everybody, but I can be there to make money off of it in a weird, morbid way. But it's the truth.
Mhm. And I think we've discussed some of these, but what do you consider to be the main risks when you are shorting?
Well, now most recently it's been a short squeeze. um,
That
I
that
think
that would
that
be maybe an interesting topic. I mean, how do you avoid or yeah, how do you try to avoid short squeezes, right? Because you can be, even though you're right, you can be proven very wrong very fast just due to timing and a short squeeze.
yeah, no, I mean there's always ways to structure a short. I mean you can just go short shares, you can use options, you can do if you're doing options, you can do spreads, right? If you're doing shares, um, you can go long one company, short the one that you're trying to short, right? There's ways to balance it out. It's not just, and that's I think another misconception, especially among the retail community, is that when somebody says they went short, they just automatically assume that you went short shares at a very large portion of your portfolio, and if it goes up a certain amount of percent, like, haha, you were wrong. It's like, no, that's not how it works. Like, no sane person does that. No
Mhm.
sane person who knows how to short is just like, you know, randomly just taking one side of this trade and expecting it to, especially if it's risky, expecting it to just go their way off the bat. That's just not how it works. So there's a lot of ways to do it, and then position sizing is one of them. And then the very bare minimum is like, just have, if you don't have any intricate structure to your trade, you just set limits, right? Like if you feel like, hey, my risk tolerance is max maybe 20% on a 3% position. Okay, that's what it is. If it goes past that, all right, if it goes up any higher, maybe I'll re-enter at a certain point in time. I'm not going to blow myself out in the sense of being right because I want to be right, right? Um, so there's different ways to cut it, but
How does that work? I'm talking here because I've never shorted, so I don't know. But when you're long and you get a situation, let's say you set your limits on the downside, but you've got significant market distress, right? You get I don't know, a 10% sell off in a given day, or you get a very fierce sell off. Then it's tough, right, to go out inside your limits because everything's going to be dropping. Everyone's trying to sell, then the spreads are going to widen a bit. So it's tough to get out exactly at the price you want, especially if you manage a lot of capital. How does that work when you're shorting and you get a short squeeze? Imagine you're short shares and you get a massive short squeeze. I mean, is getting out of that position relatively easy, or do you face like more losses because everything's going up like in a vertical way?
yeah, I mean, if things move very, very quickly, or they can move very, very quickly. So in instances like that, the liquidity goes up. I mean, because people are either buying into the squeeze or they are covering into the squeeze. So you're automatically getting above and beyond the average volume that you would get in a normal trading time frame. And like you said, it's always harder the more capital you have because it's hard to move big blocks of shares at a time unless the liquidity is there. Because otherwise, if you're trying to move shares, a big block of shares, and 1,000 other funds are trying to move the same block of shares, it obviously just keeps putting pressure on the stock, and that's what causes the squeeze, right? So that's why there's a function of position sizing, because you're not trying to move. Like if your normal long position, and I'm just using rough numbers here to make an example. If your normal long position is, to say, 50,000 shares, right, and you're in a small cap stock, potentially, the average daily volume to completely move out of that position would probably take you like a couple of days. Um, Whereas, if you're having a short squeeze, uh, and you have the same amount of shares, but the average daily volume is now pushing 4 times that, but everybody else is trying to do the same thing. It just gets really harder to minimize your risk when everybody is trying to run for the same door, right?
Hmm.
The long side is just naturally easier because bias is always, I can deal with short-term pain for long-term gain. But in shorting, if everybody is running outside of a burning building,
Hmm.
sometimes you get trampled, or sometimes you get burned, or whatever. So it's tough. I don't think there's like a right answer besides like you just try to get out as quickly as you possibly can, just like everybody else.
And when I recorded my an episode with George Livadas from Upslope Capital, he said that some of his most successful shorts or longs probably had been like, some of them had been the same position, but he flipped short, or he flipped long. And he discussed, maybe I'm making everything up, but I'm pretty sure we discussed this in the episode. He also discussed that there are synergies between long and short, right? Because you know a lot about the company, so you can identify when the thesis is long and when the thesis is short. And I think this fits very well with your journey with Hims and Hers. ticker IHAMS. So can you maybe explain first what made you go long, and then what made you flip short?
Yeah, so great example to talk about. Uh, so no, I was long hymns all of last year. Uh, and the reason why that is, in full disclosure too, so Hims and Hers Health is one of the few publicly traded telehealth companies, right? So it's you being able to see the doctor over webcam or over digital messaging to get treated for whatever medical condition that that platform is able to offer. So the disclaimer there is I was a previous employee of their competitor years ago. Um,
Mhm.
and I still hold my shares that I got as an employee when I worked for them. So that's the disclaimer, but I don't know anything about their business, what their strategy is, or anything. Um, so when I got interested in HIMS, it was basically because I have my own pool of employee shares that are private. I can't do anything with them. I know there's some level of value there, but on the public market side, it's like, hey, there is a public company that's basically doing the exact same thing whose company I know very well and whose business I know very well because I was building it. So my thought process was, all right, um, if I already know the business, I might as well basically use them as a proxy for uh, what my personal shares would be. And if they become successful, then probably my private shares would be successful. So it's basically just me double dipping, quote unquote, but having different sources of
Mhm.
liquidity that's able for me to withdraw on, right? So I can't withdraw on the private ones, but I can withdraw on the public ones if I ever needed to. And that's why I got involved, is because I already know this business, I already know the company, I know what makes it tick, I know what makes it great, et cetera, et cetera. Um, so yeah, I was very bullish all of last year. I mean, don't get me wrong, I was very pessimistic on a lot of things because I'm not going to be absent to risks. I don't know what serious investor is going to downplay risks, but I always made them noted all throughout last year. I was like, hey, like eventually things are going to change. I don't know when they're going to change, but they're going to eventually change, and that's when the story will change. Fast forward to the end of the year, um, like the guy from Upslope was saying, uh, things materialized much faster than I thought they were going to materialize, and that that increased risk of something that I thought was going to be happening a year from now was basically pulled forward to today. And I, as a long term holder, was not going to sit there and just wait for uh, a liquidity moment that led to, a 30, 40, 50% drop in the stock price in the name of being a long-term investor. In my mind, that just doesn't make any sense to me because it's not like something I couldn't foresee. It's something that I could foresee that would have an impact, and I wasn't just going to sit there and get, punched in the stomach, multiple times because, I could.
Mhm.
Um, and that's when I flipped. So in the middle of January of this year, I flipped. I was like, the research shows that this is going to happen. I don't know exactly when, but it's going to be pretty soon. And that's when I flipped. And short interest came out, and it seemed like a lot of other people were on that same page, thinking that it was about to happen. Things got, I can only go into too much detail if we don't need to, but the things that we thought would materialize didn't materialize for a lot of reasons, and I can speculate as to why. And
So,
then
so
short squeeze happened.
the inflection, is it related to GLP-1s?
It's exactly related to GLP-1s. Yep.
Okay, so I don't know much about HIMS. I do know about GLP-1s because I'm sort of exposed to that trend. If I'm not mistaken, like you have the GLP-1 producers, which are Lilly and Novo Nordisk, and then you have HIMS that was playing in that market because there was a shortage, and they were able to sell compound versions of that. If I'm not mistaken, right?
No, you're dead on. Yep,
Okay.
dead on.
So what's the inflection? What's the risk materializing?
Yeah, and so let me start off with saying there's nothing wrong. I'm not gonna say nothing, but there's generally nothing wrong with producing something during a shortage. That's the whole reason why it was made there to begin with,
Hmm.
is to help patients get access to something that they otherwise would not be able to have access to. Great, no problem with that. I had no issues with that. My issue was that eventually it will come off. and all of the growth prospects of that one product line would effectively be taken away from them, because if you can't produce something after the shortage is off, your revenue in that segment is going to drop off, take a hit or drop off. Um,
Mhm.
so it's basically like a temporary bump to their revenue growth, to their earnings, to their free cash flow, et cetera. Again, I thought it was going to be happening like a year from now, but when more research you did, you're like, oh wait, this is going to be happening way sooner than I thought. Um, so the issue there is that there was such a high, not I mean, I'm not even saying it's past tense, it's currently happening. There's such a high demand for these drugs, because everybody wants to lose weight, whether they're, like morbidly obese or just obese. So that the demand was so high that the longer the shortage went on, the larger portion of revenue that was coming
Mhm.
in the door was just from one thing.
Yeah, so the problem was compounding eventually. Like if the longer Hims was able to generate revenue from compound GLP-1s.
Yeah, because in the short term, it's great. They're making so much money. They're swimming in cash. But when you know that the hose's water is gonna turn off abruptly, not even just like over time, abruptly, that's going to be a real kick in the nuts. And I was like, I'm not going to stand there and take that, because I know it's coming. And that was what everybody else thought too, which is why short interest jumped up to like 32% at the end of January. And then the things that we thought were going to happen uh, in the short term didn't, which then led a spike in shares being bought by retail and then covering. And then you know what? You saw stock go from 25 to like 72 in like a month. Um, but
Mhm.
that's basically the TLDR. But I'm very happy to dive into that trade because it's actively happening right now.
Yeah, let's do that because if I'm not mistaken, it was Lily that said that the shortage was resolved. I don't know if it was this week or last week, or sort of
Uh,
getting to the.
no, so Lily's shortage got resolved first in October of last year, and
Okay.
then it got confirmed in December of last year. I say confirmed because the FDA decided to do a second take and make sure that
Okay.
when they made a decision the first time, it was the right decision, which
Yeah,
it
so
which it which
to avoid
which
going back and forth, I imagine, with their decision.
Oh, of course, every day, every day. The most recent one which is the one that Him sells, which is the compounded semaglutide. That's the one made by Novo Nordisk.
Hmm.
Um, and that's what everyone was counting on to come off because the research that we did showed that there was no supply issues. So basically, it was like, um, like you going to like a grocery store to get some bread. Um, for the longest time, you've heard that there's like a shortage on bread, but then you go to the grocery store and there's a whole aisle of bread, and you're basically just waiting for like Walmart or whoever grocery store you went to acknowledge that there's no more shortage of bread, and you're witnessing it, like it's right in front of you, but you can't,
Hmm.
but nothing can happen until they say there's no more shortage of bread. Just like you can't do anything until the FDA says there's
Okay.
no more shortage in GLP-1. So we were basically waiting for that. And during that time, the stock squeezed. And then on Friday, finally, they came out and said, nope, it's resolved. You have, depending on who you are, you'd have 60 or 90 days. And after that, you can't make it anymore. And that's what happened. That's why the stock dropped 25% in a day.
So basically, when the shortage is resolved, Hims can not legally manufacture compound semiglutide. That's the thesis.
Well, that's where it gets very interesting, though, because so much precedent has shown that legally you can't do that. There's plenty of cases where you cannot do that. Um, However, what makes this trade even more special is that the CEO, for some reason, keeps telling people that he can do it and that he will do it. So now you're talking about additional head additional headwinds coming from litigation risk. So now it's not even just revenue potentially being declined or turned off. Now it's okay. Are they going to get sued because they think they can do something that historically speaking no one has been allowed to do? That's what makes it even more. I mean, it's already down. What's down 6% today? But that's what makes it even more interesting because now you have a CEO who's basically trying to go against the tide, and it's no matter of a revenue thing. It's a is this guy going to like lead this company to bankruptcy type of thing, which I can definitely get into as well. But it's like it is so interesting to be a part of this right now because so many things are happening.
And when you say today, we are recording this the 24th of February, just so people don't go and see whatever the stock is doing the day
Mm,
that this is being published. HIMS is also interesting because a lot of individual investors, right, um, own the name, right? It's
yeah,
sort of in the same way as Palantir, right? That it has such a great backing by individual investors, and which I think that have increasingly dominated the narrative for a lot of names. What does Wall Street think about HIMS at this point? I mean, when you look at across the sell side research, are they on your page, or are they on the page of the of many individual investors?
so I came from sell side. I was an investment banker, so I came from sell side. I didn't write equity research. I was on the advisory. I was like the M&A guy, IPO guy. Um, I have strong opinions on sell side because I think the conflicts of interest with sell side research run too high because you can't say anything too bad about a company. Otherwise, that company will never hire you for anything, and you're never going to generate fees
Hmm.
as part of the advisory side. So there's always a conflict of interest, which is why I don't always take them seriously if I don't agree with them. And I know it's biased to say, but um, there is bias there, and you have to take that into consideration. When it comes to the sell side views on this company, there has been one that has stood out, and I applaud them because they've had to take a lot of heat so far, and that's Bank of America. Bank of America has basically said this drug is going to come off. They are not going to be able to compound it. They are not going to be able to make as much money as they used to, and the stock is going to drop. Again, they didn't even highlight when it could happen. They just said within this fiscal year it will happen, and it will take its toll on the company's stock price. Then you have other sell side people who are like, nah, it's worth definitely worth $40, $50, $60. One person came out, BTIG came out, well, a week ago and said it's worth $85 a share. And it's only because these guys are like following the stock price and they just keep releasing these reports. So it's hard to gauge what sell side sentiment is because most of them are just trying to like get in their good graces to eventually get some type of fee. But then when you talk to buy side people, which is where honestly I think the real opinions matter, I had people left and right contacting me about it because I've been writing about this thing for a while. I was talking to them, I was talking to lawyers, I was talking to doctors, I was talking to pharmacists, I was talking to everybody, and everyone's just like, I don't see how they're going to be able to do this. There's no way. I don't know what I don't know what they're talking about when they say they can go and do this at scale. Um, uh, so on the buy side, it was very pessimistic. It was yeah, they're like, no, we're short. Like you call somebody up and like, no, we're short. We don't think it's gonna happen either.
Hmm.
Um, so it was a very big shift between publicly from sell side being optimistic and then privately from buy side agreeing with me saying there's no shot.
Hmm. I completely agree with you in that the incentive system, even in a lot of the buy side, is a bit strange, right? Because you probably need to generate or try to generate alpha every year, or else
Yeah,
people are going to look bad at you, which is evidently not very possible. I mean, it's fine to have years of underperformance so long as over the long term you manage to outperform. But in the sell side, there are also quite a few conflicts of interest, right? I mean, and for listeners who don't know, the sell side basically, when we're talking about equity, releases a report, and the objective is basically for their clients to do something like give a recommendation to their clients. So then you're basically making transaction fees what you're selling. And as you said, Paul, if you start talking terribly about a company, it's not only that maybe that company is going to choose another business to do whatever they have to do, but also maybe you get significantly reduced access to management. So then that's a problem, right? Because then you're working with less information that other sell side analysts.
Yep, and that's why the conflict of interest is there because you have to keep it's really messed up because you have to keep the relationship, otherwise you don't have access to the information, or you'll never most likely never get any fees generated for your investment bank for future services rendered.
There's actually here a very good anecdote. I don't know who was the or what book I read this in on, but when Jack Welch was basically, let's say, inflating earnings through the financial subsidiary, there was one analyst who noticed it and started talking bad about the company before it peaked, and he basically knew he had ended his career at that point, even though he was saying what he thought was right, and he was eventually right. But evidently, when you're such a large company like GE, you have a lot of ties to these banks, and you can make your way through until the analyst thinks what you want them to think, right? So I think it's not a problem of the sell side analyst, but how everything is structured, because at the end, you're just working and you have limitations. And this is one of the limitations that you have.
And I'm glad you brought that up because actually I want to click into that real quick because I think it's important. And you mentioned this in the beginning. That a lot of long investors don't like short sellers because there's short selling firms that will release a report, stock drops, they'll cover their position and they'll make whatever percentage that they made prior to the launch of the report. Again, not good. I don't support that. I never will. But there is a level of hypocrisy when it comes to the objective bias against short sellers because using that same analogy, you have a short selling firm who has a negative bias on the company where if the company's stock drops, they will have a favorable outcome if that happens. On the flip side, you know, you have long funds who will build up a position, a long only position, and then they'll come out and say, yeah, oh yeah, no, I love Domino's. Yeah, Domino's is a good investment. And then the stock pumps 20%, right? So there's a level of hypocrisy there because long investors will cheer a firm or a fund who's like, yeah, I'm long this company. They'll go on CNBC to talk about it or Bloomberg or whatever. And then the stock jumps 5, 10, 15%. Well, mind you, they've been buying for the last 6 months. And then they get that nice pump for themselves. They might not sell, but they'll still get that unrealized gain on their books because they publicly went out and talked about it. Long investors, or especially retail, have no issues with that, but they will have issues when a short seller comes out and says, "Hey, I think this company is over earning, or I think management is, being overzealous, or whatever for whatever reason," and they won't like that because it's just a negative connotation. There's a level of hypocrisy there, and then to add insult to injury, sorry, to sell side firms if you want to be able to generate business for your investment bank on fees, you have to talk nicely to them, either neutral or nicely. For you to get access to management, you have to speak neutral or nicely, and to be able to actually sell that said research outwards to clients, right, to buy side, um, you need to be able to have access to the management system in order to sell. So it's all intertwined, right? So it's in their best interest to speak positively about a company, even when it might not be for the right reasons. And then you have investors who take that information or take that objective bias and then make investment decisions on it, whether it's right or wrong, because it's been like I don't do that. I know you don't do that, but it's been vetted by sell side, right? So it actually does influence public opinion. It does influence investor opinion, investor sentiment, investor decisions, etc. So there's this, in my opinion, there's this whole like hypocrisy about, if someone comes out and pumps a long only stock, it's a good thing. But if someone comes out and says there's something wrong with this company, I'm short, it's a bad thing. And then sell side just helps with that. Unless sell side has the balls to come out and say, I don't think management is right, and I think this is why, They just
But they have to
perpetuate
be
the
they have to
problem
be probably extremely sure to come up with something like that.
because they're putting
Um,
their reputation on the line. Yeah, they're putting their reputation on the line. And I want to say one quick example, because I shorted a company. It was called the Honest Company. I'm not
mhm.
sure if are you familiar with the Honest
No.
Company? Okay, so the Honest Company was founded by Jessica Alba, the actress,
Hmm.
and it was basically a baby products company. And it was all organic, it was clean or like vegan or forget what it was. It was just like super non Johnson and Johnson. And the company IPO'd, and I put out my report on it. I said there is no way that this company is worth what they think it is. Um, the growth prospects, the growth expectations, all of that does not make any sense. It does not make any sense. And I said, I'm short. I said, I'm short this company. All the sell side research comes out obviously after the IPO because there's a grace period. Everyone, everyone but Bank of America said that it was a buy. And I was like, wow, Bank of America, it stood out. Good for them. And then literally a couple of days later, after Bank of America was the only one that said it wasn't a buy, they changed their mind and said it was a buy. Fast forward a couple months later, the stock drops from I think 21 and eventually settled at like $2.50 or something like that. So a classic example of sell side changing their opinion because consensus makes them the ugly duckling and they don't want to be left out.
I've always wanted to do an experiment. Probably tough to do it, but I've always thought that if you get, say, I'm not even going to say sell side analysts, if you get 10 investors and you give them the stock price and you tell them arrive at a reasonable valuation, most of the price targets will be around the current stock price. But if you don't give them the stock price, I'm pretty sure that the valuations would be all over the place for most
I
companies.
would agree. I would agree with you wholeheartedly. I would agree with you.
I mean, and you can clearly tell that that happens, right? You only have to see where the estimates are and where the stock price is to see that they are
Yep.
okay. I can deviate from this, but I cannot deviate too much because then
Yep.
people will think I'm crazy.
Yeah, and they'll get around that with either like maybe pushing out the year, so it's not even fiscal year 2025, it's fiscal year 2026, or some of them, I think too. During COVID, some of these sell side guys were pushing out estimates to like, yeah, it's like 20 times forward EBITDA 4 years out. I'm like, who is valuing any of this 4 years out with so much unknowns? Nobody's doing that. Um, so no, yeah. So there's ways that can finagle it, and I see it on Twitter all the time. To naive investors who don't know any better, but they look at it and they think it's like gospel, right? They're like, oh yeah,
Mhm.
Morgan Stanley says this, or oh yeah, JP Morgan says this, and like that means nothing. That means less than nothing. If there's anything useful in those reports, it's because there's some data points that you or I could not get on our own. That brings up a good and value additive argument. Otherwise, I could care less about that stock price target. I could care less about if it's a buy, sell, or underperform. I could care less about that.
Mhm. I mean, I
But
think there are good sell side shops. You need to know where you're looking at, right? Because a lot of some banks would be very good in certain sectors and maybe terrible in others. But there's good research, but that doesn't mean that the price targets are anything are going to be accurate. I mean, the one thing um, that I struggle with is that there's a lot of confirmation bias when you see sell side research, because if you own the company and the sell side says, hey, it's going to go up, you're like, well, probably they're right. And if they say the opposite, you'll say probably they're wrong. And probably they're wrong both times, right? Because they don't have a magic ball.
Well, and there comes short selling, right? I mean, like I don't have to be public about anything that I write. I choose to, right? And I take a lot of risk in being very public that I'm short something. And that's not for glory. I could care less about that. It's mainly because, it's a marketing tool, right? Like, hey, Cedar Grove Capital Management, I've done the work. I think Hims is a short. Here's why, you know?
Mhm.
So it helps with like marketing towards not only just me but also Cedar Grove Capital. It's also like the strategy. It's also being able to see things where other people haven't, right? And I know you're a big fan of Connor, which I am as well. And I've gotten a lot of flack in the past with shorts, right? And they've worked out though. It's like Peloton, for instance. I I I went short Peloton. I made it public, And the amount of backlash I got for calling out Peloton and saying like it was over earning. There's no way this is sustainable. Grossly overvalued. Margins will come down. This thing makes
I
no
don't short,
sense.
but I don't short, but if I shorted and I got a lot of backlash, probably I would take that as a positive sign.
Oh yeah, I mean, you would think, right? I mean, obviously there's a mental component. You don't want to be switched around, but no. Look what happened to Peloton. Peloton completely capitulated. It went from I think it was like 140, $150 a share. I think it bottomed at like $3. And that
Mhm.
whole time I had to basically just take it from people like, no, it's gonna turn around, no problem. Oh, now it's gonna turn around, no problem. Oh, now it's gonna I'm like, okay, we live in whatever fairy tale land you want to live in, but it's not gonna happen, right? And then there's other examples too, like I shorted Sweet Green when it went public. Sweet Green should never have been valued at that high. I shorted Robinhood. Robinhood should never have been valued that high. Chewy for pet food and pet supplies, shorted that one, right? There's a company called App Harvest that was valued at over $1 billion for farming tomatoes indoors. Are you kidding? Like what? It was like, and then the Chamath one, the Virgin Galactic, taking people to space for space tourism. There was no number in the world that was going to make that company even remotely sustainable, let alone valued at what it was currently at. So you have all these things, and you take a lot of heat. And the thing is, you have to have. No, I'm tuning my own horn here when I say this, but like, yeah, if you're going to be a short seller and be public about this things that you're shorting, you got to have balls because you're gonna take a lot of heat from people, just like
Mhm.
I took a lot of heat from this Hims position. But the thing is, I'm not wrong. It eventually happened. Yeah, their short squeeze took place, and there's still a lot of air to be let out. But I'm not wrong on what's going to be happening. And Friday was testament to that, at least for the first domino. We'll see how the other ones unfold later this afternoon.
Mhm. So thank you for coming to the show, Paul. Before finishing, we were talking about books before started the recording. So what's your favorite investment related book?
Oh, that one's a hard one.
You can say three. I mean, I cannot even think myself
Three,
of
I'll
one.
go three. Okay, so three. So one that I really liked is I know it's so cliche, I know, but it's Peter Lynch's One Up on Wall Street. That was like one
Hmm.
of the first finance books that I read. Absolutely love it. It's a very easy read. It teaches you very easy conceptual concepts. For the
That's
entertain,
probably, in my opinion, one of the best introductory books to investing.
yes, if you're just starting out and you're listening to this, I recommend that one. It's also cheap too. I think it's like $10 at this point.
Hmm.
The second one would probably be Barbarians at the Gate. I'm a very slow reader just because I can't read fast. I'm trying to digest everything as I read it. Um, and that book was one of the few finance books where I could not put it down. I was so invested into that story that I just wanted to learn more and more and more about it. Um, and then there's like a lot of other ones that I have too, but I think one thing I always read too is probably like one of the Michael Lewis books, whether it's like The Big Short or something. It's because it's like entertaining. I know there's movies about it and whatever. Um, but whenever I think you can attest to this, whenever you understand like a financial concept or a financial part of history, and then there's a book on it and you read it, you're like, oh, cool. Like this is like I can follow along. It's fun. I understand
Hmm.
it. Blah blah blah. But I got like 50 other books here too, but I'll keep it to those three.
I think those three are great. So thank you very much, Paul, for coming. I think it was a great conversation, especially on a topic that I don't discuss a lot on the podcast. So thank you very much.
Yeah, no problem. People don't hate short sellers, just hate the ones that dump after they pop.
Okay, bye bye.